Good afternoon. I'm Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. It's a show about personal finance, investing, borrowing, saving. It's a show about personal finance, about helping you to become your best possible version of your financial self. We talk about a lot of things, but what I want to talk to you right now is just a reminder of how treacherous investing could be over the short term, about how disheartening investing could be over the short term, and about why so many people give up on investing. You see, personal finance, the basic concept is easy to understand. Spend less than you make, save some, and invest the rest. It's a pretty simple concept, but we have things that get in the way, like impulses and life. And not everybody who spends a lot of money, more than they should, is necessarily a spendthrift. It's just that life comes at us in different ways, at different times, and different speeds. And we realize we don't have as much control over things as we were taught that we would have. If you do all of these things, you'll get this. You do all of these things, you'll have this job, this career, this income. But then we become adults and we realize doesn't it doesn't work that way. Not always. In fact, many times it doesn't work like that. So that's why we talk about planning. But I'm more into not just planning, but planning for contingencies, planning for when things go wrong, planning because shit happens. And when it happens fast. It takes a long time for good things to happen, but bad stuff happens quickly. As a former branch manager once said to me when I was knee high in my career, knee high to a grasshopper. So that's what we're talking. Now I'm seeing there's no video. Okay, Chris, let me double check that. Are you sure there's no video? Let me see what I have going on my phone. Let me see. All right. There is no video. Wait, the video seems to be going in and out, which kind of sucks because there are a whole bunch of people watching and I don't see the video. So, just a black screen. Eric can see me. Um, well, maybe it's a social media problem. Audio is fine. All right. Hopefully. All right. Now you're watching me adjust my settings, and it's just been one of those days. Let's see. Is it still showing that I'm live? Hmm. I'm just gonna have to go on with the show and act like nothing's wrong, because hopefully it's being recorded and I'll get some nuggets out of this. So anyway, if you're listening, I thank you for listening. Um, it does look like it's back. See that? Okay. All right. So, all right. Anyway, sometimes these things happen when you go live. Remember, this isn't cable TV. This is live streaming on social media. It's still a little primitive in as much as we invest in equipment and time, game prep, these things still happen. So let's get back into the main topic. And I appreciate everybody watching. And of course, while you're watching, if you have any questions, please um, ask away in the comments. I'd love to hear from you. It's the best part of doing this. And while you're watching, of course, give us a thumbs up, a heart, an applause, whatever reaction is available to you on whatever social media platform that you're watching from. Okay. So we make plans to help take control of things. We go to school, we get a job, and we kind of goad ourselves into thinking we have control. Sometimes people become dissatisfied with their lives and then they lose control and they realize how much they would like to get back to that point which they just said they were dissatisfied with. Sometimes you just don't know how good you have it. Sometimes you do. So that's a general concept, though, that I think is part of financial planning, but maybe not explained to you in such a heavy way. So this is why we make plans. This is why we do things, financial advisors. This is why we talk about life insurance. We're not all trying to sell you a high cost life insurance policy. We're not all here to tell you that we are experts at tax reduction and estate planning. By the way, please consult with your tax advisor when it comes to taxes and tax planning. I am not an accountant and I'm not qualified to give tax advice. And when it comes to estate planning, that sort of thing, please go to a qualified attorney for that sort of thing. I don't give legal advice. Okay. And also, I might as well throw this in. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Okay. I got all the disclaimers out of the way. So now what I'd like to do is roll over, and I see you out there, Chris. I see your question. I'll get right back to you. So let me roll into the um, quick introduction, and we've got a show to finish up. We're going to make this pretty short, and a couple of quick announcements to make as well. All right, we're back. Thank you very much. So we talk about control and we talk about illusions. And a lot of what we see in the stock market and the economy, well, I should say the stock market, is it's a little elusive, a little illusionary. And I think over the long term it's not, but over the short term it is. And we are pushed around as far as stock prices and the value of your portfolio of your life savings often gets pushed around for reasons that either we don't agree with, that are very short term in nature, or um, often for reasons that we don't even realize until some time passes. And a lot of people don't want to rely on that. They don't want to put their money into an investment or investments that they don't have control over. This is a lot of the reason why I think a lot of people like to invest in real estate, for example, because they feel they have more control. They're doing something with it. They're using their hands. They're actively pursuing ways to maximize their returns, as opposed to individual stocks. The way to maximize your return over time is to do nothing, is to be hands off. And I think a lot of people forget that. So when times get tough, people say, I don't want to deal with this. I want out. I don't want to put my money in here. Or as they say, my money don't jiggle jiggle, it folds. And that is apropos of absolutely nothing. So these are the things we talk about. And that's why I tell my clients, I will spend a lot more money telling you what not to do than what to do with your money. People think, oh, you're a financial advisor. You tell people what to do with their money. What should I do with my money? It's more of what you shouldn't do with your money. The game plan to grow your wealth is pretty simple. Most of us make money, we spend it. If you can save and invest a little bit, you're golden. And since we know that whatever you save will probably not be enough to retire on, if you can invest that little bit of money and earn a return on it, then you start to talk about growing your wealth more substantial over time in order to replace your income when you retire. That is the basis of investing. That's our why. Ultimately, that's our why. Now we all have different loves in our life, different passions in our life. I get it, and those are our whys. But if I can give a broad stroke why, we want our money that we're accumulating now, our wealth that we're accumulating now, to replace our income down the road. It's pretty straightforward. But things get in the way, like emotions, like saying, let me just do this and then I'll get back to investing. Let me just pay for this and buy that. And then I'll get back to saving for retirement. Let me just do this. Let me just do that. 20, 30 years goes by pretty quickly. And this is why it's so important to have plans, even if we can't control them, even if we get thrown off track. Because one of the things that goes with the plan is priority. We get to prioritize our spending. And that's what I want you to do here. I want you to prioritize your spending. I'm not saying never get a cup of coffee again if you love coffee. And, I love my iced coffee. But there are other things I won't spend on because my priority is my $4 worth of happiness and ice over here is worth it to me. But then there are other things that I will quickly not spend on or eliminate from my budget because they're not priorities. So it's all about priorities, and it's about a few other tidbits of information. So what do you think of this? Am I making a good point? Okay, so let's talk about the stock market. Stock market had a big drop on Friday. I had a really good quote, by the way, in Newsday, my hometown paper on Long Island, where the reporter called me up and said, we're talking about the market and Fed policy, what's happening. And the first thing in my mouth was, there's going to be a lot of heavy drinking in the Hamptons tonight. And that's the quote they went with. It was pretty funny. I think it's the best quote I've ever had in the media. We did talk about Fed policy and other things, which is also quoted for in this article. And one of the things I want to make clear is Friday wasn't about the Dow being down 1,000 points. That's a big day. Yes, it's and the other major averages were down percentage wise pretty substantially, all 3.5 to 4%. But why is it a big deal? It's because of we have a different Federal Reserve chairman. Not it's the same person, but Jerome Powell was a kinder, gentler central banker where he really wanted to maximize employment, minimize unemployment, and help anyone who wanted a job to find a job by keeping the economy going as strong as possible. And he said, I'm not going to raise interest rates. Even inflation exceeds our 2% target. We're willing to exceed that to make sure we've got durable, steady inflation, which means he can keep the pedal to the metal and keep stimulating the economy to help more and more people find jobs. Well, be careful what you wish for because he got it. We have not only sustainable inflation, but highest in 40 years. So now he's got to pivot, completely pivot, and he's done it. Where now he's no longer the kinder, gentler chairman of the Federal Reserve. He is the hardcore, steely-eyed, cold as steel, mannequin-like robot who's going to raise rates, tighten Fed policy, make borrowing more expensive in order to tamp down inflation and slow the economy. It's a real sea change. This is enormous. This is one of the biggest, quote unquote, sea changes / paradigm shifts that I've ever seen in my career. That's how big this is. And I'm wondering if people are really taking it seriously enough, or they just think, oh, Friday was just a down day. The Fed's going to chicken out and cut rates as soon as we see the first sign of trouble in the economy. What the Fed told you is, no, we're not going to do that. That happened in the 70s, and every time the Fed, were led by Governor Burns of the Federal Reserve, every single time the market got weak or the economy started to get weak, the Fed would get scared. They would stop raising rates, cut rates, and inflation would just come back more viciously, more aggressive, more virulent. And it became a disaster. Paul Volcker finally jacked up rates in the early 80s and kept them up until inflation was truly slayed. Powell wants to do that now. He just doesn't want the mistakes of having to cut rates every time he worries about the economy, or every time we worry about the economy. It's a paradigm shift. It means we really don't have the Fed backstopping anything anymore. It's like we're on our own now as investors. And now we have to be real investors. We can't just be buy the dip investors or buy everything investors or buy what's hot investors. It's become a lot tougher, a lot more difficult. I'm excited about it. I think it's going to be great. We're going to have a great ride and everything's going to be okay. And now I really get to use my noggin for research as opposed to just buying on dips, buying what's hot, just buying everything because, it's the market. It's always going to go up. That is a good thing. So let's take a look at the major averages. Dow down 184. NASDAQ down 124, down 1%. This is just all a continuation of yesterday. Gold barely budged. Oil had a pretty big day. Oil stocks are up today. The 10-year yield is 3.10%, slightly up. The euro, oh, wow. The U.S. dollars are trading at one parity compared to a basket of currency. So the U.S. dollar continues to get stronger. The VIX is barely up, which just goes to show you it was still a pretty tame day. What I mean by tame is there were no major fireworks. 1 year, 3.4%. The 2 year, 3.429%. And the 10-year, only 3.1%. See that? This 3.1 versus a short-term yield of 3.4, this is backwards. This one should be 3.4, and this one should be 3.1. But when they are backwards like they are now, it's called an inverted yield curve. It's a lack of confidence in the U.S. economy. It means that investors are expecting inflation, that they're expecting recession. We still may have a deeper recession. I've been saying for a while that we're in a recession. You've heard me say that before. I don't think we got out of a recession. I just think that we have to acknowledge where we are in the cycle and invest accordingly. So how do you invest accordingly? For me, I want you to know for my own personal accounts, I've changed nothing about how I'm investing for myself, regardless of this market. I don't change everything because it's a down market. I change because my clients are a year or two away from needing their money for something. So then I sell to raise the cash to put it into something stable so that when they do need the money, it'll be there for them. So they don't have to sell more shares in a down market and have a harder time recovering down the road. So that's what I do. Greetings. Hey, Rita from Jamaica. Ooh, very nice. Wow, Jamaica. Jamaica sounds pretty awesome right now. Hope you guys are having some pina coladas, having a great time, and that's amazing. You took the time to watch the show while I'm doing this. And some housekeeping things. I'm probably not going to do the live stream for the rest of the week. I do this Monday through Thursday every week, but it's the week before Labor Day in my neck of the woods on Long Island. It is dead as a doornail. There's no cars in the parking lot. It's pretty much vacation mode. It's kind of like a few days before Christmas. There's just not a lot going on in the market and in business. So unless something really crazy happens in the market, this will be my last one for the week. And I'll come back to Tuesday after Labor Day, come back strong and bring on some guests and things like that. So Chris asks, what CDs would you recommend? I'm looking at Capital One, but then there are others that have higher interest, but not sure if I'm missing something like hidden fees. You just have to ask. You just have to ask. I'm not sure what fees there would be in a CD. CDs are generally, this is the rate you get. This is the length of time you hold on to the CD, and that's pretty much it. I don't really think there's much more research to do, but go look at banks that you find could give you the best yield for the right term that you're looking for. I don't know if one bank for the other is going to be that much different for a short-term CD. They might be like 1/10 of a percent or 0.2% difference. Sometimes there's a teaser rate available for people, but I'm not really, enthusiastic about the prospect of finding higher CD rates at other banks. If you have a bank you like and you're looking to just put money away for the next 6 to 12 months, CD is a stable place to go. It's FDIC insured. Why not? It's not a big deal. I wish I had a better answer for you, but I don't think there really is like any great answer. It's exactly, Chris, as you probably would find and expect anywhere you go. So thank you for asking. All right, so that's pretty much the story for the day. I'm going to get going. I just want you guys to hang in there. I want you to realize that individual stocks don't always recover, but the markets always recover, which means index funds always have recovered. I want you to understand what kind of investor you are. I want you to take money that you need over the next 12 to 24 months and move that money into cash, even with the market down right now. And I just want you to practice good personal finance habits. I don't think anyone expects me to tell you what the market's going to do over the next couple of months, or what it's going to do tomorrow. What I want to do is I want to go through a process and surrender the result. What I want to acknowledge is that there are a hell of a lot of things that I can't control. Okay, like Fed policy moves, Russia invading Ukraine. I can't control these things, but they can all affect the stock market over the short term. But over the long term, you have corporations who are managed by people who are incentivized and motivated to make money and to pull everybody along with them, in particular, shareholders. So that's what I'm focused on, and I think that's a good place to be. Thank you very much. Have a good night, and I will speak with you all soon. And Chris, you are very welcome. Thank you for asking. Take care, guys.